Howdy, Jacob here. Today we're looking at Dover Corporation, 25.2 billion market cap on 27.8 billion enterprise value, founded in 1947 in the machinery industry. They provide equipment and components, consumable supplies, aftermarket parts, software and digital solutions, and support services worldwide. They do have a dividend yield of 1.1%. Their revenue growth is very lagging, 7.8 billion to 8.4 billion. You're looking at maybe 1 to 3% revenue growth year over year. Nothing too impressive. Gross margin down a little bit, operating margin up a tad. Operating margin fairly impressive, 16%. Gross margin fine, 36%. They do pay a dividend, and it doesn't look to be that much of a payout, so that's good. Return on invested capital recently, very good. I guess historically as well, very good, averaging well into the double digit, well, not well into, but 10 to 14% return on invested capital is very impressive. Balance sheet shows 399 million cash on hand with 468 million short-term debt, 3 billion long-term debt. That 3 billion long-term debt is going to be a little over 3 years of their 5-year average free cash flow. So not terrible. They're just going to have to focus on sustaining that, and they could sustain that by just growing free cash flow and not taking down that debt at all, or just paying down a little bit of debt at a time. I think 10% of capital allocation to debt reduction makes sense to me. Outside of that, their dividend is going to be paying out about 30%. Share repurchases are a good amount, and then acquisitions are a good amount. So we're ready for assumptions here. Revenue growth side is going to be small. That's what we've seen in the past. That's what I'm projecting for in the future. This is with a lot of acquisitions. They've also had divestitures, but I mean, they haven't had a net divestiture since 2017. And even since 2017, growth is not that much better in inflation. So let's say about 4%. Let's increase that a little bit because their return on invested capital is decent. So I think they're going to have less growth in the market, but higher capability of return on invested capital. So if they do have an opportunity to reinvest, they will get a good return on it, even though a lot of the money is just going to dividends, share purchases, and acquisitions. For margins, let's do 12 and 11%. For share change, 1% is about 250 mil. Offset stock compensation, 280 mil. It's about 30% of free cash flow. And the dividend, how much have they increased that in the past? 1%. I like it. Just to say that they are a dividend aristocrat or whatever. Okay, so this is assuming roughly 30% to dividend, roughly 30% to share purchases, and then 40% to acquisition, reinvestment, debt pay down. So I think I'm comfortable there. And then we're saying it needs to fall 65% before you get the return we look for here. So it just looks a bit pricey for me. The business looks fine. You're not going to be seeing a lot of growth, so you're going to want to be getting it a little cheaper in my perspective. Hope you enjoy the video and have a great rest of your day.